Hello everyone. Today I'm going to discuss about the topic about financial management. Uh, Today we will walk through key financial management concepts that form the foundation of corporate finance. These insights are not only useful for the students of finance but are crucial for decision making in a business environment. The concepts we will discuss here is the range from strategic goals of finance to the principles of investment valuation, operation fit performance, sustainable growth, and risk return trade-offs. In this particular slides, we're going to discuss about the goals of financial management. There are four concepts involved in it: shareholder wealth maximization, ethical consideration, agency conflicts, interest alignments. So at the heart of finance lies one fundamental goal: maximizing stakeholder wealth. This means decision makings that increase the long-term value of the company stock, unlike chasing short-term profit. Shareholders will maximization encourages sustainability growth and prudent risk management. A major challenge here is agency conflicts. Managers who are hired to act in the business in the best interest of shareholders may at times prioritize personal gains such as job security or higher salaries over maximizing the company's value. So in this particular slide, we're going to discuss about cash flow from assets. One of the most central idea in finance is understanding how much cash a business generates from its operation. This is captured in the concepts of cash flow from assets, which reflects the cash left over after a firm pays off for its daily operation and investment needs. First, we look at operating cash flow. This is the money a firm earns from running its core business. It excludes investments or financial activities and focuses solely on how well the company turns sales into cash. Finally, we account for working capital, which includes short-term assets and liabilities. Changes here affect how much cash is tied up in things like inventory or account receivable. Combining these components tell us whether the company is generating surplus cash or requiring outside funding to stay afloat. So this is in this particular slide we're gonna discuss about DuPont identity. To understand what drives a company performance, we need to dig deeper than just looking at final numbers. The DuPont identity helps us break down return on equity, one of the most widely used performance indicators, into three areas. Finally, we evaluate profitability. How well does the company turn sales into profit? This shows operational efficiency. Second, we look at the asset usage. How effectively is the company using its resources to generate revenue? Third, we are examine financial leverage. How much of the company's operation are funded through borrowed money compared to the shareholder investment. So in this particular slide, we're gonna discuss about sustainable growth rate. Every company wants to grow, but growth that's too fast can be just as risky as stagnation. The sustainable growth rate tells us how much a firm can grow using only internally generated funds, without taking a new debt or issuing new shares. This rate is shaped by two main forces: how profitable the company is and how much of the profits it's retained rather than paying out in individuals dividends. A highly profitable firm that reinvests most of the earnings can sustain faster growth without turning to external financing. Understanding this helps managers set realistic growth targets and aligns expansion plans with the financial capacity. It also alerts firms when their ambitions might outpace what they can afford. In this particular slide, we're gonna discuss about present value and discounting. Now let's talk about one of the most basic yet essential ideas in finance, the concept of time value of money. This idea explains why money today is more valuable than the same amount in the future. Imagine being offered $1,000 now or a year from now, even without inflation. Receive money today is preferably because you can invest it and earn a return. So this is the why future money cash flow needs to be discounted back to their present value to compare them properly. Discounting is used in valuing project, pricing securities, and asserting in any situation. In this particular slide, we're gonna discuss about annuities and perpetuities. Not all cash flows comes in a lump sum. Many financial arrangements involves a series of regular payments like loans, leases, and retirement income plans. An ordinary annuity pays at the end of the each period, while an annuity due pays at the beginning. Understanding the timing of these payments affect how much their wealth they worth today. Being able to access these structured cash flow helps in evaluating financial decisions, plannings of retirement, or pricing long-term contracts as well. So in this slide, we're gonna discuss about bond valuation. When companies or governments needs to raise money, they often issue bonds. Investors buy these bonds and receive interest payments over time, along with the promise of getting their original investment back as a maturity. The value of the bond is determined by estimating what all of those future payments are worth today. This depends on how much interest the bond pays, how long it lasts, and what return others similar investments are offering. Understanding bonds it is critical for both individual investors and corporate finance professionals because they are a key part of financial system. In this slide, we're going to discuss about dividend discount model. Stock valuation often comes down to estimate how much future benefit an investor will receive. In this case, the dividend discount model is a method used to estimate the value of a stock based on its expected future dividends. This model assumes the dividend will grow steadily over time. We estimate what those future payments might be and then figure out what they're worth today. This method is especially useful for evaluating companies with a stable dividend policies such as utilities or established consumer good firms. In this slide, we're going to discuss about risk and return. Risk and return are inseparables in finance. You can't earn higher returns without taking more risk. The key to understand what type of risk you are facing and how they can be managed. There are two main types of risk. Systematic risk is related to the entire market, like economy downs, inflations, or global crisis. This affects all investment to some extent and cannot be avoided. Unsystematic risk is specific to the company or industry. This includes things like product failure or management scandals. The good news is the type of risk can be reduced through the diversification, spreading investment across the different sectors and assets. Smart investors build portfolios that manage risk while still aiming for good returns. There is an art and science of investment strategy. So in this particular slide, we're going to discuss about capital asset pricing model to help investor decide if the stock offer a fair return for its level of risk. Finance professionals often turns to the capital asset pricing model. This model considers how much a stock's price moves in relation to the market as a whole. The moment is known as beta. A stock with a high beta is more violate and therefore riskier, but it's a more potential for higher returns. And these factors is the relationship along with the return you would expect from the risk-free investment and the average market return. The result is a benchmark return you should demand for the given level of risk. And here we go with the conclusion. In wrapping up, we would cover a broad set of foundational ideas in finance, from defining the true goal of finance management to understand how value is created and preserved. These concepts are essential for anyone seeking to make sound financial decisions, such as topic we discussed play a role is in the bigger picture, evaluating companies' performance, managing growth, assessing risk, and making investment choice. They are not just academic; they are practical tools used every day in corporate boardrooms, investment firms, and entrepreneur ventures. As you continue your journey in the finance, keep returning to these principles. You will not only guide you understanding what you will also help you ask better questions and more informed discussions. You can lead with the clarity in your financial role. Thank you so much. ఇదేంటి ఎక్స్పోర్ట్ చేయాలి కదా ఇప్పుడు.